this moment, I am particularly proud to be here for the 8th time at the 8th quant. So once we spoke in Italian, but time is changed. So, and I want to thank Daniele Bernardi for the invitation. Because I am happy to be here, and I want to thank Daniele Bernardi to inviting me to speak about target return strategy, because this is an idea we have shared, an idea we have studied together. So at least 50% of the ideas I will present is Daniele Bernardi ideas. So thank you very much. A target return strategy is an ex-ante set of dynamic rules that maximize the probability of achieving a given return in a given time horizon. The time horizon is a rolling one and not a target one. This means that we don't want to invent a magic fund that is a bond and that incredibly it pays a coupon. In our case, the time horizon is actually a risk control tool that obliges the strategy to remain on track, not far from the target line. We will see this point in minutes. We are in a risk-neutral environment where ex-ante we don't know, unfortunately, the driver of performance. So we will discover the pro-tempore driver or drivers of our performance using our rules, and we build accordingly the portfolio. So our investable universe must be well diversified, including all possible sources of systemic risk. It could be useful to have short positions or investment objects that replicate the short position. This is a very important point because obviously we don't know if we will find something systemic or systematic risk we can follow. So we need probably to build a short position for a period of times, like an edge position or a position or a short position. This graph could easily represent the idea. We have a target in our mind. This is the target. We want to obtain a 7% return during a 5 years period. This is our objective. I don't know if it's possible or not, but obviously we can choose a target return that we consider a good objective. And then we will discover if we will be able to have this return using the drivers of performance we have in a market-neutral environment. We don't know if bonds or stocks or some kind of sectors. So in this way, the idea is to try to follow to track the line, to try to follow this our big great objective. In this example, this is a back test on target return strategy on 10 asset classes. We will see the asset classes in this chart. Our strategy is the red line, and the other lines are the 10 asset classes we use to obtain the strategy. In this case, we discovered that it's possible to have this kind of return. Diaman ratio, the target return strategy is based on this idea, and this is another idea that we shared in origin with Daniele, a risk-adjusted performance indicator that measures the linear trend return in relation to the degree of the linear determination coefficient. The Diaman ratio is calculated by a linear regression of the logarithmic transformation of the market value of the asset on time. The Diaman ratio is the beta of the regression. It must be clear that this beta is not the beta on the market, but is the beta in respect as a result of regression on time. So it is not a beta like a systemic or systematic risk beta. It's a completely different idea. The beta is our target return, our linear target return. So the beta multiplied by the R squared of the regression. This is a famous fund, and in the last 12 months, and the idea is to make a logarithmical transformation of the net asset values of this fund, and then very simple, we calculate a regression. And obviously we have to test the significance of this coefficient. This is a very important point. And if this coefficient is significant, we can say that this is the trend, and we can calculate our Diaman ratio, this risk-adjusted performance. The performance is 2.87, the beta, and the R squared is 0.35, so the Diaman ratio is 103, and this is actually a performance, risk-adjusted performance. The risk is the R squared. Does it make sense to optimize a portfolio using the Diaman ratio approach? The R squared is the risk, and the beta is the expected linear return. We have an expected return in this case. And this is a very simple map, a classical risk return map, where the risk in this case is the R squared inverted scale, and this is the expected return. And the chart shows us the Italian bills, treasury bills, EU bonds, global bonds, US stocks, and so on. Obviously, the risk is zero R squared is the higher possible risk. The portfolio optimization consists in maximizing, in this case, the R squared for a given expected beta return. We present a comparison between the traditional mean variance ex post optimization and a Diaman ratio ex post optimization, and a different kind of optimization, ex post optimization, classical ex post. We ask for the optimal ex post portfolio that realized a 7 return mean with a minimum volatility. This is a mean variance optimization, and a 7% beta with a maximum R squared. The results are obviously different, and they make sense. For example, in this case, the Diaman ratio optimization in a 5 years time horizon, an ex post optimization, we build the portfolio, and in this case, the portfolio is the red line, the Diaman ratio optimization, the blue line, the mean variance optimization. As you can see, there is differences between the two optimization, and the idea is that the Diaman ratio optimization prefers the stability of the line. Stability means intuitively the ability of the line to remain on track, and introduce the maximum drawdown and time to recover, for example. Does it make sense to realize the selection using the Diaman ratio? The idea is to make a comparison between the Diaman ratio short, like a moving average, 26 weeks, and the Diaman ratio long, 52 weeks, and to select the asset when the Diaman ratio short is greater than Diaman ratio long. In the following case, we build an equally weighted portfolio with the indices selected by Diaman ratio criteria. The comparison is with an equally weighted portfolio of the 10 indexes used, we have seen before. Obviously, this is not a proof, this is clear, but only an application to clear it down. This is the result with this kind of selection using this simple moving Diaman ratio criterion and the equally weighted portfolio. Obviously, this is only an application to real time. So, target return strategy and Diaman ratio. Do you remember the objective of target return strategy? So, we want to realize the portfolio with a given target return using a large investable universe. Our portfolio must present a maximum stability around the line, and that represents the target return. It is intuitive. The relation between the target return strategy objective and the features of the Diaman ratio we have just presented. Let's start with our target return on February 2008. This is the idea. We have only an idea in our mind. The idea is to obtain a 7% of return. We are completely forward-looking. We don't know if it will be possible to obtain this return, but we want to obtain this return using the asset classes and the investment objects that we have, ETF, and so on. We have 10 asset classes, and every week we optimize the portfolio, maximum optimize following the Diaman ratio optimization, maximum R-square for a given beta 7%. The Diaman ratio parameters are calculated for a 6 months horizon. After 1 year, after 2 years, after 3 years, after 4 years, after 5 years. Interesting. Obviously, this is only an example, a real example on 10 asset classes, and we have to implement the model and to calibrate the model, obviously. So we have presented a very simple and very lucky case of application of the target strategy. It's possible to implement the strategy introducing some additional features that help to realize the objective in different market conditions. The problem is that we don't know the future market conditions. 2 features: moving beta, increasing the value of beta target in the optimization when the portfolio is under the target. Moving horizon. Do you remember that the horizon is a moving horizon? So we have not the objective to liquidate the position after the maturity of 5 years. Moving horizon, starting a new 5 years horizon if the portfolio value is above the target line. So, in this case, after 1 year, the idea is when the portfolio is under the target line, the beta will be increased. Maintaining the 5 years horizon. Instead, when the value of the portfolio is above the target line, moving horizon helps to consolidate the results obtained. A new 5 years horizon, 5 years horizon, a new 5 years target line with the original target beta, 7% in this case, is found starting from the maximum portfolio value. This is the idea. Obviously, moving beta and moving horizon works together. The new beta target is calculated in comparison with the new target line. So in this case, in the new horizon, that probably is in the new horizon we increase the beta if we are under the new target line. Okay. Let's say it's important to define a minimum acceptable R-squared. Under this value, the portfolio is invested in a risk-free asset. This is a kind of risk tolerance of the model. It's important to define a maximum beta target for the optimization to cut the risk appetite. This is another very important point. Obviously, we have to calibrate it. The investable universe must be very large to be able to exploit all the opportunities that the market will offer. But the optimization is very difficult if the number of investable objects is too large, as you can imagine easily. So we implement a two-stage strategy using the selection power of the object. The securities under optimization is chosen every week by the comparison between the Diaman ratio short and the Diaman ratio long. The fund of funds application, very simple. We are gathering the data of 10 funds from January 2001 to February 2013. We realize the target return strategy from 2001 every 3 months with a 5 years horizon. So we have 26 5 years portfolio results. In the first stage, we used the 6 months Diaman ratio and the 12 months Diaman ratio. Okay. This is the result. This is our target line, and this is the result for our portfolio. 26 portfolio that starts every 3 months from 2010 to 2008. As you can see, we have excellent results. We have good results around the line, and we have some cases in not so lucky case, and like this one, in which we not reach the target. Obviously, this is an ex-ante strategy, so it is impossible to obtain exactly the result. It would be could be very easy to obtain this kind of result. Is very, very, very interesting. No drawdown, no low volatility, but that ex-ante, we don't know if the market we will obtain this result, and we discover that it has been possible. Okay. This is the best result. Start on April 2003. This is our line, and this is the markets. Or better, the funds we have used. This is an emerging market fund, for example. And this is the worst result. This is not, look at this moment. Very difficult moment for our strategy. Very difficult moment. This is a difficult moment. It's from 2010 to 2011. Obviously, we have to calibrate the model, so it's possible to obtain something different. This is one of the ideal results. This is the ideal result. As you can see, we have interpreted the markets, giving the investor a stable return around the objective. The result that we have presented is only an exercise based on real data using the target return described. The most evident limitation is the number of funds we used. Obviously, the strategy must use a large number of, for example, ETF or funds. For this complete application, you can do the Diaman stuff. You can obtain all the data you want. Okay, to conclude this speech, I want to present the results with the same simple data over the entire period of time, from 2001 to 2013, and I think they are interesting. As you can see, we have given a good stable result with the period. The problem is here, and we can interpret, looking at the data, the motivation of this kind of situation. And this is the 2001 period in numbers with different asset classes and our strategy. Okay, so have a good lunch time or have a good target return. Thank you very much for